All right. Letting everybody join. See what happens. Hopefully we get some people on here tonight. First call. Got some hopefully some good. Here we go. We got some people joining. Let's see here. Grant, what's going on, man?
Not much. How are you?
Oh, I'm doing awesome. Just thanks for joining our first master. I'm gonna call it master class call, not mastermind, but one of those things. It's kind of
Yeah, man.
going over the just kind of back to the basics a little bit, just showing some numbers on out of the gate, some preliminary stuff. Just someone wants to purchase a vehicle and how to pay that back with interest, kind of the stuff that we talk about all the time. So just wanting to show some math behind it and some numbers. You know how it goes. So
Absolutely. I think this is very helpful.
yeah.
Appreciate you facilitating it.
Oh man, 100%, 100%. Wait for a few more minutes for people to hop on here, and then we'll kind of go from there. Yeah, I said an hour to everyone. I mean, we can hang out here for an hour. It can be longer, it could be shorter. Just kind of going off of everybody, what everybody is thinking or whatever. But I'll share my screen here once we get to about 6:05 and people give them a few minutes to hop on and things like that. We'll kind of chop it up and go from there. But did anybody have any issues jumping on or getting into I know Grant, you told me that you're not on Facebook, but hope it wasn't a big issue getting at least into the Facebook group. Okay. I'll ask you guys too. Is it again? I'm not in the time wasting business. So, does it make more sense to just hop out of the gate, just get going, or does it make sense to kind of wait for about 5 minutes for people to jump on and then? Because again, this is the first time that I've led something like this, and I'm just really wanting to not waste your time and just stay on top of what we're trying to accomplish. So. But if that's good with you guys, kind of give it a few more minutes and go from there.
Totally good with that.
Okay. Okay, cool. And I feel like, just with, there's some college basketball going on today and this evening. So I know that people's focus can be elsewhere. It's actually really hilarious. I had who actually is already a client of mine who is in our mastermind and everything. He asked for a policy loan. Him and his wife are, redoing a part of their kitchen or whatever. He wouldn't mind me sharing this. They're redoing a part of their kitchen, and he's like, "Can I get $15,000 in a policy loan or whatever it was?" And so he got a policy loan, and of course the Razorbacks, Arkansas, won their game the other night, and so their Sweet 16 game is in Las Vegas. So he's like, "No, I wanted to let you know I'm actually taking a policy loan and buying tickets to the Arkansas game in Las Vegas." Now that is infinite banking in action. So I thought that was pretty funny. Just literally guys using a policy loan. If you want to talk about infinite ways as to finance something, he's literally taking a policy loan and buying Sweet 16 tickets in Las Vegas. So
there you have it.
Pretty funny. Well, look, here's what we'll do. We got a few guys on here now. I want to jump into this. Derek, Jonathan, hey guys. So I'm going to share my screen. I'm just going to, I don't want to, you guys are already clients, so I don't want to go over things that we already know, but I just want to kind of go over the why again, and kind of back to the basics, just kind of out of the gate, just a reminder of, hey, this is why we do things. This is the reason why we're using this vehicle to finance the things that we do. So if that's good with you, I'll share my screen here and then we'll kind of chop it up. So I'm not going to bore you guys with slideshows, but it's good just to like be able to see this. See if I can minimize you guys here. Here we go. And if you have seen this, I'm not sure if you guys have or not, but this is a new little slide deck we've been working on, and I'm pretty happy with it. But here we go. So again, guys, we finance everything we do. That Nelson Nash said that, you know, in the book, Becoming Your Own Banker. We borrow someone else's money and pay them interest, or we pay cash and give up the ability to earn interest. So what does this look like? Let's say that our cash account, whether this is $10,000 or $100 million, we all have cash sitting somewhere that's idle. It's liquid because we need to get our hands on it. But it's not money that's invested out in some type of not risky, but a stock market and a real estate deal. But it's just liquid idle cash. It's essentially rotting away to inflation. We all have that amount sitting somewhere. And so what the majority of people do is they do the opposite of Dave Ramsey, and they go and borrow someone else's money and they pay that back with interest, right? They borrow 100 grand or $75,000 to go buy a car or an investment property, and they pay back that lender with interest. Or you have, again, the 15%ers, and that's the Dave Ramseys, where they save up money and then they go and spend it on that asset. They're above that cash threshold and they're in control. But then when they spend that money, they've now given up the opportunity cost to earn on their dollar. So you can see that we don't really get anywhere. I almost kind of look at it as the way of when you borrow someone else's money and then when you pay cash, a sink fund and using other people's money is it's identical. It doesn't get you anywhere because our cash never does anything. We never grow inside of our cash account. Obviously, infinite banking, what we're doing is we're never allowing our dollars to be interrupted, the compounding to never stop growing. So even when we access those dollars, obviously we are not interrupting the growth of our cash value in our policy because, again, we're leveraging the death benefit. It's a prepayment of death benefit, and that allows our equity to continue to grow and compound as if the dollar never left. So just to show again kind of the different columns of where you can house money, it's pretty simple. It's tax today, tax deferred, and tax never. Tax todays are your Silicon Valley checking accounts. It's probably a lot lower if it was about a month ago, but you've got your savings, your tax deferred like your 401ks and your IRAs, and then your tax never is money sitting in your safe or infinite banking or properly engineered life insurance. And so just looking at kind of these attributes that are important, just on the left-hand column here, just, most people in a high-powered or at least an equity account where we keep safe dollars, we would like to have these attributes: competitive return, safety, liquidity, tax-free, or at least, not partnering with Uncle Sam, creditor protection, and then uninterrupted compound interest. So let's just go over this first column first. And if I'm going too quickly, guys, I don't want to jump ahead too quick. I just you guys have seen this before, and I just want to reiterate why we're doing this before we jump into some details in the case study, if that's okay. So again, tax today's, savings accounts, we're not earning anything, maybe a couple basis points, but the safety and liquidity portion, of course, you can go down to the bank and get a check out the next day if you needed it. Obviously, it's not tax-free. Every dollar that you grow doesn't feel like we're earning anything. But if you were to actually earn 3 pennies, Uncle Sam in a 1099 will ask for one of those. It's not creditor protected. Anytime, you were to be sued, the first place that attorneys are going is your checking account. And then obviously it's not uninterrupted compounding. When you if you had 100,000 in an account and you took out 50 to go buy a car, you're now only earning on $50,000, right? That's, you've withdrawn that money. Tax deferred accounts. Let's talk about competitive rate of return. We hope that these 401ks are competitive. That's why we have them in these accounts. Obviously it's not safe. It goes up and down. We've seen that just in the past year, how most accounts are down 25 to 30%. That's not political. That's just what it is. It's not liquid. Obviously, once you put that money in there, it's tied up for 30 plus years. You can't get your hands on it unless you want to pay a penalty and then, capital gains tax. It's not tax-free. It's tax deferred. You're partnering with Uncle Sam for the long term. It is creditor protected depending upon the state that you're in. Thankfully, that's another box you can check. But then obviously it's not uninterrupted compounding. When you withdraw the money, when you take the money out of the account to go spend it on, in retirement or whatever you do, well, you're removing it and it's no longer growing anymore. Well, obviously life insurance and this infinite banking policy that you guys have, they check all of these boxes. Competitive rate of return, you're getting at least 4% guaranteed plus some dividends that are tax-free. So I like to be conservative and say 4.5%. Safety, you cannot lose money when you take a policy loan. It's contractually guaranteed to have more money the year before than you had the previous year. It's liquid is to where you say, hey, Nolan, I need $50,000 to go put a down payment on a property. I'd say, hey, sounds good. It'll hit your account in 2 to 3 business days. All the growth in these policies are tax-free. And let me explain this really quickly as to why these policies are tax-free. So think about, obviously this is insurance, but most people would say, why? I don't understand why there's not a capital gain. Why is the death benefit tax-free? Well, think about it this way for a second. When you go get in a car, you have car insurance, you pay, whatever that number is, $350 a year in car insurance. And let's say that you get in an accident and you have to go take your vehicle to go, get fixed, and it costs $5,000. When the insurance company writes that check for $5,000, I would ask you, is that a capital gain? Is that a capital gain when they wrote you a check for $5,000? No, you've been paying interest, or I'm sorry, you've been paying premiums in insurance in case of the what if, in case you get an accident. So when the insurance company comes in and writes that check for $5,000, you're not getting a gain. You're just being, that money is replacing what you've lost. So think about it this way. You had a $5,000 loss because your car was wrecked into. The insurance company comes back in and writes that check for $5,000. There's never been a capital gain. It's only been that you've been a replacement cost essentially. And so that's why what happens is the reason they're tax-free is that death benefit candidly is not yours. It's your beneficiaries. And so if you happen one day to pass and you've got $1 million of death benefit, when you go and die, that beneficiary, again, that $1 million of death benefit has been, again, that beneficiary lost $1 million of some type of revenue or your services to the world and your income, and they're being replaced with that $1 million that they would have otherwise earned, with you being the owner of that policy. Therefore, the policy is tax-free. I just wanted to kind of clear that up as to why these policies are tax-free. And all the politicians understand that. That's why they made it this way. Obviously too, it's creditor protected. No litigator, no, even states can't even put liens on these things. Once the money's in these policies, especially, I've done a couple podcast episodes on my Infinite Banking Radio podcast about how important creditor protection is, especially when you start to build your net worth and putting money in these policies and using trusts as a way to, eradicate any litigation opportunity. But again, the main driver here is the uninterrupted compound interest, because when you take a policy loan, you are not withdrawing your own money from the policy. What I'm saying is, and I'll explain this in a minute, is you are actually using the life insurance company's money out in the marketplace. Your money continues to grow and compound as if it never left. And I'll show a comparison here in a minute. But you've seen this before. I won't dive into how the policies are created because that's not really important. Here we go. This is what I wanted to talk about. Let's compare our life insurance policies to a home equity line of credit or a HELOC. So if you're looking on the left-hand side here, you see that, let's say that you owned $1 million home and you had $100,000 of equity, whether you was a down payment or you've been making payments, which, every monthly mortgage payment, there's principal and interest attached to that. And you build up $100,000 in equity. Well, let's say that you and your wife, or you yourself, whoever it is, wanted to go and borrow money to go and redo the kitchen or redo the bathroom, and you borrowed $50,000 to do that. Well, when you borrow $100,000 from your home equity line of credit, you're not interrupting the appreciation of your home, right? The neighborhood and the comps in the area. You keep making your mortgage payments. You're still building equity. The bank is writing you that check based upon the asset, which is your real estate. It's identical in whole life insurance, or at least in infinite banking. What we're doing is, the only difference is that we just have different names. So instead of it being a line of credit or a home equity line of credit, we're using this as cash value. And then the death benefit is the asset, the same way the real estate is the asset to the bank. So when you go and have this equity, because you're making premium deposits, when you're making these deposits, you're building equity or cash value in your policy that you're in first position. You can take access, you have access to this whenever you want it. And you go do the same thing. You borrow the $50,000 from your life insurance policy to go do that same thing on your home. Well, the life insurance company is actually borrowing or letting you borrow based upon the death benefit. That's what you're borrowing against. This is the asset. The same way that you're borrowing against real estate in your home is to the bank, as the asset is to the bank. I hope that kind of makes sense as the comparison between line of credit with real estate and basically whole life insurance as a line of credit that you own and you control. Okay. So this is just a policy example. I won't kind of get into the details. We'll go over some, the policy and everything like that here in a minute. Just a couple examples. See here, there's a couple highlights. Okay, let's do this real quick. Hope that makes sense so far. Hopefully everybody has seen that, and that's and does that you can get off the mute for a second. I want to make sure that you have any questions about that before I move on to the next step.
Yeah, makes good sense, Nolan.
That makes sense, everybody. I hope that's okay. A thumbs up or whatever. Again, this is my first time kind of doing this, so I'm going to get more. I'll get more, savvy as we kind of go along. So I appreciate you guys working. Nick, thank you for the thumbs up. I appreciate that. I'll start using that moving forward. I just wanted to make sure that we understand the why before we kind of jump into the how, if that makes sense. Okay. So I'm going to share my screen one more time here. All right. And now I'm going to go into a couple, and by the way, this is Nick Franklin right here. He's a handsome fellow. This is from my wedding. Let's just jump really quickly. This is again, this is not a specific individual, a certain client right now. I just wanted to go generally first. Because again, I didn't really know how this was going to go. As we keep building up, guys, what I'm going to do is I'm going to reach out to somebody that's a client of mine already and ask if they would like to become kind of, client of the month. And then we'll just kind of break, not get into their own personal situation, but just talk about their policy, what they're doing with their policies. Grant, you and I have actually spoken about that. You might be my first little guinea pig. But just talking about, how you're using your policies to, use leverage, to use arbitrage, to, create wealth. But, and I appreciate that. So let's just talk about this policy really quickly. So again, there's a lot happening. You guys have seen this. This is like 9 pages long. You all have this. But there's a lot happening. And I just want to focus on these highlighted columns. Basically the cash outlay is our deposits, and the cash value is what we have access to. Again, that's our equity that I just spoke about. And so we make these deposits. And again, this isn't going to happen overnight. This is a long-term play, a long-term savings account. We make deposits for 10 years, and this looks really pretty. We have a lot of flexibility in this, as you guys know. But let's just say that, we had this robot or Johnny Appleseed decided to make these deposits. Here's what our cash value is going to be after 10 years. And so let me just make a quick highlight of this, the non-guaranteed versus the guaranteed, because most people would look at that and say, well, what is non-guaranteed? I need a reminder on this. Well, like I mentioned a minute ago, remember, we have a guaranteed interest rate of 4% on our money. And then we also have dividends. And dividends, if you remember, dividends are profits that the insurance company earns. And so when you go, every other policy or every other product that insurance companies have, term insurance, IULs, variable universal life, all these other hybrid products that are out there, you are essentially betting against the insurance company, okay? It's the same thing as you going into Las Vegas with a term insurance policy and slapping it all on red. They're going to spin that table. And if you don't die, well, then all of that money that you paid in premiums just goes in profit to the insurance company, and they hardly ever pay out. So that's a huge profit center for insurance companies. Whole life insurance, on the other hand, is the only product in which you are an actual equity owner in that mutual insurance company. And that's the policies, the policies my wife and I have. We're just putting one on my kid right now, my 7-month-old. So the whole life insurance, it's basically the same as you depositing in now, I'm not going to call it investing because it's a savings account. But when you go and deposit money with these mutual insurance companies, which is what you guys have done, you are literally now an equity owner in this company. And so the same way as you would make an investment in a stock portfolio like Amazon, you're going to receive dividends. Those are taxable. Because these are insurance, these are tax-free dividends. And that is a profit. So when the insurance company goes out and earns a profit, they say, hey, you give us 25,000 that Johnny Appleseed did. We're going to guarantee you 4% for you partnering with us. And then all of the profit that we earn on the back end by, again, in term insurance, IULs, we actually go lend it. We go buy, conservative bonds. We go build shopping centers. We buy mortgage-backed securities, collateralized debt obligations, and we earn a profit. After we pay out all of our expenses or our costs, whatever's left over, that's dispersed as a dividend to all of the policy owners. And that's what you and I and all of us have. And that's what the form of a dividend is called. And so just to lay that out, what those are. So I don't like to use the word non-guarantee because it's these insurance companies that we work with, Emeritus in general, they've paid a dividend for 136 years in a row. So they anticipate, we can't guarantee it, but we can get as close to guaranteeing as possible in the financial world as saying dividends will be paid because they've got an entire liquidity pool ready to deploy in regards to dividends. So that's another reason why I just why we focus on this column and not this guarantee column. Fair enough? Okay. So again, the policy is cool. It's this is better than a checking account. You're not going to earn $16,000 on 160 grand at the bank because you have to pay taxes on that. Remember, like I mentioned, for you to net 10 grand. Now, again, this is a 40-year-old man. Some are older, some are younger, but you can generally, this is what it's going to look like. It's just going to be a policy that's just going to keep growing and compounding. You see down here in year 9, Johnny makes a $10,000 deposit. His cash value goes from 155 to 170. So it's as if he went down to the bank and wrote a check for $10,000, and then he immediately writes a check back for 15 grand. Now that didn't happen overnight. It took him some time to get there, but that's kind of where hopefully we're all getting with our policies, where the main game is we go down and we write that check for 10 grand. We immediately capture that growth. We borrow out our cash value and we deploy it into the marketplace. Once that marketplace hopefully provides a return, we fill our bucket back up as time goes on. Okay. So let me make sure everybody that's on here, I want to make sure that all makes sense to everybody. Can I get a thumbs up that makes sense, or do I need to go over anything else? Okay, perfect. All right. Thank you guys. All right. So let's keep this rolling. Okay. So what I did is, and I've shared this with you guys, I believe in the past, is a little thing called an infinite banking promissory note. Okay. And this is, I kind of set this up for this call. But Johnny Appleseed wants to go buy a vehicle. And so again, this is a little promissory note. You've probably seen this on your home or your mortgage or your car payment. And basically when you borrow someone else's money, you promise to pay them back with interest. So I kind of said, okay, how can I create something for my clients to where they can kind of stick to, being their own banker, right? That's the whole point. We want to become our own banker. And so what I'm showing here is Johnny borrowing $20,000. And let me go back here. Let me pull up another policy here. If we go up here and see that in year 2, he made a couple deposits of 50 grand. He had basically $40,000 in cash value. Okay. It's a couple $1,000 behind of his deposits, but again, we have to take that step back because that's what keeps it tax-free. But in year 2, he had $40,000 in cash value. So what Johnny decided to do is go borrow from his policy $25,000 to go and purchase that vehicle straight up and down outright. And so what I would encourage you to do, or I would encourage Johnny to do, is not only refill that $25,000 just with 25 grand, but attach some interest to it. Because again, infinite banking, is not describing life insurance. It's describing how you behave with money. It's describing what you actually do when you go and take money out of an account. So you can actually practice infinite banking out of a shoebox underneath your bed. It's the act of taking out $20,000 and filling it back up with $21,000. Like, that's infinite banking. That's all it is. So what I would encourage Johnny to do here is, hey, we're going to take out 25 grand on April 1st, and we're going to charge ourselves 6% over the next 60 months. So every month, where normally that 6% interest rate or that $387 payment would go, because if you remember us going back to the spender saver, where most people would borrow money and pay interest back to somebody else, again, we're not ever getting anywhere with our money. We're charging ourselves interest to, that would have otherwise gone to somebody else. So over those next 5 years or those 60 months, we're going to charge ourselves 6%, which it's not a really big deal. But again, $3,200 basically in interest that would have gone to somebody else that you have now recaptured and put back into your pocket. All the while, your policy was still chugging along and accumulating and growing compound interest. So what I did, okay, so before I jump in, does that make sense? Does that kind of make sense? Thumbs up. Or do I need to run back and run it back over again? Does that make sense to everybody? Okay, cool.
Crystal clear.
Okay, perfect. Okay, so there we go. Okay, sweet. Okay, so what I showed is Johnny Appleseed. I wanted to show what a policy looks like when you borrow money. Okay, what happens if you actually practice infinite banking out of a life insurance policy? What happens? So if you notice here, this is almost identical to the same policy I just showed you a minute ago. The difference is, let me pull my highlighter up, is we're taking cash from the policy. So here's what we're doing. If you notice, in year 2, we took a policy loan of $25,000. And then if you did the math on this, let me see this, what is the, 387 per year is $46.44 per year, or, $387 a month is $46.44 a year. And so if you notice, every year he's filling that account back up with interest, and you get almost to identical the same spot. Look what happens in again, remember what I showed you guys a minute ago from year 9. He made a $10,000 deposit. Well, I guess he's right here, however, I'm 31 now. My eyes are starting to get to me. Sorry. But he was at 134. He made a deposit of $10,000, and his cash value went up 15 grand again, which is identical to what I was just mentioning on the policy before, or, if he didn't take a policy loan. So really, guys, the whole point here is that when you guys are financing things, it's best mathematically to run money through a policy before you go and just spend the cash. Because when you get down later on, where else can you make a deposit of 10,000 and it immediately turns into 15? Imagine if this was 100,000. Imagine if this was 100,000, that 100 grand would turn into 150,000 immediately. Imagine what the ability, like the things that you could do with that money that other people won't be able to do, because they're just going to be refilling that money back up into their account, and they're not going to have any of this growth. So that's basically the goal, guys. We're just using this as just the warehouse of equity. If you could think about it that way, it's not an investment. We're just enhancing our equity position before we go out and deploy it into an investment. We go buy vehicles, we go buy an engagement ring, we go we go take a trip to Italy, whatever it is. When we go fill our money back, our account back up with interest, and we get down here later on in life, it shows that it makes sense because we've been compounding on this number, on this column, the entire time. So hope that all kind of makes sense on kind of a very surface 30,000 foot level. Does that kind of make sense? Sweet. Okay. All right. That's kind of my first little, 30-minute, jump into. I want to see if anybody has questions. Like, let's kind of open it up for questions. If you do, great. If you don't, that's okay too. I really just want to bring value to you guys. Like, because again, when I was first introduced to this idea, I wasn't given this. I was basically given a policy. they taught me a little bit, but it was more of, hey, here's your life insurance policy. You're a real estate guy. That's great. You go do real estate things, but I wasn't really taught the ins and the outs and the math behind how to use it. And so honestly, I want to help you guys the best way that I know. And I think it's getting in front and having dialogue with you, figuring out your situation and where you are, what you want to accomplish, and figuring out what I can do to help you guys achieve what you want to achieve. So that's kind of where I'm at with this mastermind. I don't really know where it's going to go. I just know that I really want to help you guys, again, achieve what you want to achieve. So kind of as we go along, we'll have more, other infinite bankers that are in this group. We'll talk about their unique situation, what they're doing with their policy loans. Obviously, our Facebook group, which I know a few of you guys aren't in yet. Hopefully, you will. There hasn't been a ton of activity yet. Again, I just kind of started it last week. But I really believe that this is going to build some momentum. And so if you guys have questions, again, I'll be silent for 30 seconds or whatever. If someone wants to kind of chime in with the question, and then I can kind of answer it. But mostly, I just want to get your feedback on how I can help you guys like get where you want to go. If that makes sense.
Yeah. Hey, Noel. No question here, but I really do appreciate the information and the rundown, and I'm definitely happy to be a part of this group and an infinite banker. So I really appreciate your time.
Awesome, dude. Thanks, Nikki. I appreciate that, bro. Thank you.
Yeah, Nolan, I really appreciate you setting up a forum like this. I think it's great to be able to have the one-on-one, but I think the additional learnings that we'll be able to share across the group, I think will be really invaluable, because everybody brings different ideas to the table. And even in a short period of time that I've come across this concept and learned, I can't tell you how many different ideas that I've been thinking about and how I want to use my policy. And so I think this forum really allows us to really tap into it to a much larger degree. So again, appreciate the forum. This is really, I think, going to be a really great thing.
Awesome. Thanks, Grant. I appreciate that.
Mm-hmm.
Well, again, then here's kind of what we do. That we can kind of cut this one a little shorter than no big deal. But if you like, what I'll do is when we get off of here, I will. What I'll do is the recording will be finished. If you like me to, I'll put this that little promissory note. You guys might have it. If you don't, I'll put this in our group. That way you guys can kind of download it and have it for your own leisure if you like. Again, excuse me, I'm not going to tell people that they got to like use that when they take a policy loan. I just do that and show people that because, I mean, when I take money, when I borrow from a bank, they write that up and I have to, pay them what they're owed. I just think it's a good way of knowing where your money is. And not to mention too, if you're in business, interest is deductible. So that's another thing that you can, if you really wanted to get cute with your accountant, which I know a few guys are business guys. But most importantly, guys, what I'll do is I'll record this, I'll upload it. You guys can have this if you want to, replay it. But I really, again, I can't hammer down is like, I know how I felt when I first started. I felt kind of like, okay, I took a first step. I want to do infinite banking. Now, what do I do? Like, okay, I want to get from A to B. How the hell do I get there? But I know I want to do it, but how do I do it? And so I'm hoping that this will be a couple steps as to, okay, guys, okay, we're going to keep walking through this together. We're going to, churn some ideas in our head. That person's doing this person's doing that. So I really just hope that this will be beneficial to you as you guys go on your financial journey and we all kind of build wealth together. So, but if anything, what I'll do is if you guys, again, I'll email this out, respond to me as you guys, as before the next month's, mastermind like this, maybe shoot me a couple topics, a couple things as, hey, what if I was to buy a boat? What if I was to purchase a piece of real estate? Because real estate's what I'm really passionate about. And that's what I like to talk about, but I don't want to talk about what I want to talk about. I want to talk about what you guys want to know. And so that's where my real head is trying to dissect what you guys want, and let's dive into how you guys want to use these things, and let's figure out the best way of doing it. So if that works with you guys, that's kind of where I guess I can leave it, if that works.
Hey, Nolan, Derek here. I got a question for you. Thanks for putting this thing together too, by the way. So
Yeah. Yeah.
very informative. Question on the promissory notes. How far do you go with it on your, for instance, on the, do you send DocuSigns to your LLC and do, make it up? How official do you make it, or
Hey,
does
that's
it
a great
does it
question.
matter for tax purposes?
That's a great question. I personally, I don't really get that fancy with it. I don't get super official where I've got like an actual summary page and I've got to like submit it or anything, because realistically, watch this. I mean, literally I can do this, I can change it. You can do anything that you want to it, really. It's pretty malleable, but in my opinion, it's really what you make of it, right? I mean, as long as you don't need this promissory note in order to charge yourself interest. You don't need a document in order to refill or capture interest. It's just simply, as long as hey, I'm going to take out $10,000 in my PNC checking account and I'm going to put back $10,500. If you just tell yourself that, and that $500, that's interest that you're charging yourself, well then bam, that's deductible. I just like having this as just a way of, if something was to ever, come up and I had to be audited somehow, well, guess what? I've got a promissory note from A to B showing that, hey, I actually did charge myself interest, and, my accountant has it on file, in case something was to come up. But I don't DocuSign it or make it crazy fancy, but that's up to you. That's your prerogative,
Do you do any type of amortization schedule with it, or is it set up their auto pay, or how do you go about
so
that?
This is amortized. So these $25,000 right here, if you notice, I'm paying back. So like, whatever that math is, if you notice, so what is $3,800 or 3,387 times 60 is $23,220. Oh, is that right? Maybe I did my math incorrectly. Maybe I was looking at a 25-year amortization. I'll have to look back at my math. Maybe I'm off on that. So maybe I need to go back to, I did go to college for 7 years, and they call those people doctors, as Tommy Callahan would say. But what I do is trying to think about what you just asked me now. The way that I look at this thing is just like, you can amortize it out as long or as short as you want. Make this thing, 360 months if you want to make it 12 months. I really think that's the cool part, is this $25,000. It's the line of credit that you own and you control. Nobody else does. So the bank doesn't make these terms, you make the terms. So you can be as, fierce and aggressive as you like, or you can be more passive. If it's an investment property and the tenant moves out that month and you guys had to rehab a property, well, take that month or two off of repayments and, get your feet back under you, get your capital back up a little bit before you start repaying again. So you can't do that at the bank, right? They're going to foreclose. So at least here, you have the control of that capital versus somebody else. And so as you keep building that, liquidity and that pool of capital up, you're just going to have more control over your assets versus continuing to borrow from the bank and them kind of having their hands on your throat, if that makes sense. All right. Well, again, guys, I mean, if it's good with you guys, unless you guys got something else on your mind, I guess we can cut it a little short, but if that works with you, again, I really appreciate you guys hopping on, just your diligence and of being, taking this not so much seriously is not the right word, but just, taking your finances seriously. I mean, a lot of people that I know, especially my age, it's easy to kind of just get in the ebbs and the flows of, I earned this money, I spend it, I spend it, which is what, like I said, a lot of people do. They all stay on that little timeline, and it sucks because there's a way out of that kind of rat race of capital. And I really believe this is just a better way of financing and using capital and using money than just using the banking system. And so, again, guys, I'm excited about this. I'm really hoping I can keep bringing value, but unless somebody else has anything else, we can get out of here and we'll plan on chopping it up next month.
Good here, Nolan. Thanks
Cool,
for
guys.
thanks for the time
Yeah, all
going through it.
Yeah,
This is
absolutely.
great.
Cool. Well, again, guys, thanks so much. I really appreciate you guys hopping on this first one. I hope it wasn't too choppy or too much of a waste of your time. But we'll keep building this up, and I'll get more efficient, and we'll get better as time goes on. But again, guys, really appreciate you guys coming on tonight, and we'll just look forward to next month then.
Sounds good.
Awesome.
Thanks, everybody.
Thanks, guys. You guys have a good evening. Appreciate it. Go Hogs.